When we look at financial statements, we're not just reading numbers, we're reading a story that management wants investors, auditors, and regulators to believe. But how do we know if that story is trustworthy? This is where financial statement assertions come in. Assertions are the silent promises management makes with every line of the financial statements. And as auditors, or even just informed readers, we have to test whether those promises hold up. Let me break it down for you. There are 5 key assertions you need to know. Think of them as lenses that help you analyze each transaction, balance, or disclosure, and each one comes with a way to test it. 1. Existence and occurrence. This asks, do the assets and transactions really exist? If the balance sheet says there's 1 million in inventory, is it actually sitting in a warehouse somewhere, or just on paper? To test this, auditors might physically inspect inventory or send confirmations to customers or banks to verify balances or transactions. 2. Completeness. Flip the question, is anything missing? Completeness means nothing that needs to be recorded is left out of the financial statements. Whether it's a transaction that occurred, a liability incurred, or a disclosure required, it should all be there. To test completeness, auditors might trace transactions from original source documents to the accounting records, ensuring that every relevant event has been captured. They may also perform a search for unrecorded liabilities, reviewing vendor invoices, bank statements, or legal correspondence to find obligations that haven't yet been recorded. 3. Rights and obligations. Now we ask, does the company truly own what it says it owns? Just because an asset is listed doesn't mean the company controls it. Think consignment goods. They're there, but not really theirs. Testing often involves reviewing contracts, titles, or agreements to confirm ownership or responsibility. 4. Valuation or allocation. This is about accuracy. Are numbers measured correctly? Has depreciation been calculated properly? Are accounts receivable adjusted for bad debts? Auditors test valuation through recalculations, independent estimates, or by comparing amounts with market data, like checking the fair value of investments or verifying depreciation schedules. 5. Presentation and disclosure. Finally, is everything presented clearly and honestly? Are the accounting policies explained? Are the risks hidden in the footnotes or spelled out transparently? To test this, auditors review financial statement formats, note disclosures, and ensure compliance with standards like GAAP or IFRS. Wrapping up, these assertions aren't just theory, they're the foundation of auditing. Each one pushes us to question, validate, and challenge what's on the page. They turn a passive reading of financials into an active investigation. They empower us to go beyond the numbers and ask better questions. Whether you're preparing statements, analyzing them, or auditing them, these assertions give you a framework for truth, for trust. So the next time you glance at a company's financials, don't just take them at face value. Look deeper. Ask, what is this really saying, and how do I know it's true? Because in finance, trust isn't given, it's verified. If this helped, hit subscribe and check out our next video.